Joining me now on Yahoo Finance Presents is Ray Dalio. Ray, good to see you again and welcome back to Yahoo Finance. Really appreciate you taking some time. I stumbled upon on YouTube principles for dealing with the changing world order, why nations succeed and fail. This posting by you has amassed close to 10 million views.
Eventually, out of these conflicts, whether they're violent or not, come new winners who get together and restructure the losers' debts and political systems and establish the new world order. Then the old cycle and empire ends and the new one begins, and they do it all over again. That's a lot of detail I just threw at you to paint a picture of how the typical big cycle transpires. Of course, not all of them transpire in exactly this way, but most largely do.
Take us through how you came up with it and why'd you put this together?
Well, the study, I needed to understand things that were happening to us. I'm a global macro investor, and there are things that are happening in our lifetimes that never happened before. The amount of spending financed by debt, the amount of internal conflict, the rise of great power in the form of China to challenge the existing world order, and so on, the alliances with Russia and all of that. And so I needed to study the rise and decline of reserve currency. So I went back 500 years to see the Dutch guilder and the patterns of the past. It helps me. And then when I did the study, I did a book because I thought it was important to pass along. And then I wanted to make it very clear and digestible. So the animation that you're talking about is very clear and digestible so people can put what's now happening in the perspective of these historical patterns, which helps people think about what's coming next.
I will bring this more current momentarily, but I do want to ask, how does this type of exercise or this type of research by you help you become a better investor?
Well, it helps me understand what's likely to come next. Mm-hmm. Like, for example, right now, the U.S. is imposing sanctions. Sanctions it's a form of economic warfare, and it has a big implication for the dollar, right? Mm-hmm. Okay, now others are trying to get out of the dollar system. There's a dollar system that now is being changed. India is dealing directly with Russia, and holders of dollar-denominated assets don't want to hold those dollars grabbed and so on. So what's happening now? Deal with it. And I learned this in my past because, well, just quickly, in 1971, I was clerking on the floor of the New York Stock Exchange, and President Nixon gets on and he says, we're not going to give you the gold that the dollar is backed by. And we had a devaluation. It took me by surprise. It's going to go down a lot. It went up a lot. And that's because I never experienced the currency devaluation. I found the same exact thing when I studied history. Same exact announcement took place on March 5th, 1933 by Roosevelt and had the same effect. So I understood then how history before me was important. Studying the Great Depression allowed me and Bridgewater to anticipate the 2008 financial crisis. If I didn't study that, what's happening now?
Let's talk about what is happening now. Is globalization, and just using this in the context of what you have written here, is globalization at a point of failure, or has it failed?
As we likelihood of some kind of war. There are 5 kinds of wars. There's a trade war, a technology war, a geopolitical influence war, a capital war, which we're in the midst of, and then there's a military war. And those things drive countries to be self-sufficient and independent. And as a result, globalization diminishes and nationalism increases. Yes.
And what does that mean for financial markets? Because by and large, I think a lot of folks would be surprised that stocks are hanging tough, all things considered.
Well, it's not the stock market. So it's in the book, it takes you through the stock markets during war periods. And so the only thing that matters for stocks is the cash flows. And as you get into the conflict, that's a different story. If you begin to see as it progresses, those that are affected by the individual events have an effect. For example, tech stocks. But anyway, in answer to your question, how does it affect the markets? It affects the value of money most fundamentally. Like what we're seeing now is that the value of money, when you run very large deficits, and you have to spend a lot. You have to spend a lot on social programs. You have to spend a lot on defense. You have to spend a lot on environmental programs and so on. And so when you spend a lot more money than you earn, then you have to print money to make up that difference, to make the purchases. And then that devalues money. And so it's like the example, yes, the stock market goes up and other things, but cash is trash. And people then begin to learn that the bonds that they're holding have negative returns. And it starts to change the value of money, the value of dollars and so on. So money goes into other assets. It produces more of an inflation, and you start to enter a certain type of environment. And the environment that we're in is beginning to be very much like that of the 1970s.
Can the U.S. be successful over the next, let's say, decade, given where inflation levels are today and given how much debt this country is in fact sitting on?
Well, there's two ways of dealing with debt. You pay it back in hard money or you pay it back in soft money. You pay it back in hard money and you have a problem. You have a depression. So throughout history, whenever that was done, pay it back in hard money. Eventually, that was abandoned and you print money. That was what 71 was. That was what March 1933 was. And so I think that what you have to think about is the value of money. How much money does one have in debt instruments? And do you want to own that as an asset? I think they're bad assets. And so, and then how do you diversify? And the system also has to deal with what is money? What is money? Is the dollar going to remain the same sort of reserve currency? And then you see the development of alternative monies. We're seeing a variety. I think different types of money will compete with each other in the environment we're in. Some, maybe it's crypto, maybe it's gold, maybe it's other things. Maybe the digital renminbi competes with the US dollar. We're going to come into an environment because everybody thinks that think about how much money is being stored in debt instruments, those debt assets. Think about how poor those returns are. So that kind of a shift, I think, is very important.
Can the dollar stay the world's reserve currency when we are running, when inflation is at this high current level and likely to remain this way for some time?
So all currencies have a lot of debt. And so when you look at one relative to the other, there will be a lot of printing. I mean, currency equals debt. And when you hold a currency, you're holding a debt instrument. And so all of those will decline in value relative to other things. Now, will the dollar decline more than other currencies? It's almost certain that we're going to come into this environment. We're in this environment in which there's a shifting of those currencies. So you're going to see more of China's renminbi being used. You're seeing India have a direct link with Russia on the currency. So we're in an important change in the currency. But how that is a store of wealth is a different question. So a currency is a medium of exchange and a storehold of wealth. And its storehold of wealth is now a problem, particularly for the dollar, but it's also a problem for other countries. So that's why you have inflation. As money goes into other things and the cost of borrowing is so low relative to the inflation rate, then it encourages the borrowing of money and the sale of money. In other words, not holding financial assets like that. So that's, yes, I think you're changing the nature of what money is and what the dollar is as a storehold of wealth.
On a scale of 1 to 10, and this is the only way I think I can maybe ask this one, but on a scale of 1 to 10, how concerned are you about inflation right now?
Oh, I don't know, like an 8 to 10 or something like that. We're beginning a paradigm shift. A paradigm shift is a shift from a mindset, one mindset, and positioning of that mindset to another mindset and another positioning of that. So, for example, the mindset that we were in was that you have low inflation, and when you're owning bonds and you're owning cash, or you are operating one way, and you don't worry about that, and companies don't worry about it in their inventories, or having larger inventories, or homeowners don't worry about inflation as much in the purchases of the houses and so on. Once that shift begins, it causes a reinforcing dynamic. It's like everybody is long bonds. We've been in a 40-year bull market in bonds. And so it's been fine to have. And when that shift starts to take place, you see behavioral shifts that reinforce that cycle in the paradigm. So, for example, when there is the selling of bonds, that it makes it more inflationary in and of itself, because the amount of debt that has to be sold is not just the deficit, but also the amount of debt that's being sold is those bonds. So now interest rates have to rise a lot, or the Federal Reserve has got to come in there and buy more. And then you get wages. People make wage settlements that and such things. So a paradigm shift is beginning to take place, and that will be also self-reinforcing. And it's taking place in this context of the conflict, which then creates the breakdown of efficient systems. Each country wants to be self-sufficient. It needs to protect itself. And in being self-sufficient in that way, then you have less efficiencies in the system. And all of that becomes self-reinforcing. So it's all happened before. It's all happened many, many times before. That's covered both in the video and the book. So it's, yeah, I'm concerned about that.
You're obviously a student of history of all kinds. When you hear folks project that the Federal Reserve might raise interest rates 7 times this year, and given where inflation is what the Federal Reserve likely to do on rates this year push countries from success into failure, not just the U.S., but even emerging markets?
Yeah, it's funny because, everybody says, okay, there'll be 7 increases or something like that, and that sounds like a lot. But you're taking interest rates up to something like 2%. Mm-hmm. And that 2%, which starts to squeeze the capital market, starts to make it more difficult for a holder of equities, because the equity, when you raise the return on bonds and you raise the return on cash and you tighten money, then that makes other assets less attractive, such as risky assets, particularly long duration assets like tech stocks and the like. So you produce that squeeze, yes, but that's still only at 2% or a little bit over 2%, with an inflation rate which is considerably higher than that. We've had a 7% inflation rate, and we'll probably settle, it'll be a 5%-ish or something. And so you're still losing that money to inflation. People are. So what you have is enough tightening by the Federal Reserve to deal with inflation adequately is too much tightening for the markets and the economy. So the Fed is going to be in a very difficult place a year from now, as inflation still remains high and it starts to pinch on both the markets and the economy.
What can they do? Can they do anything?
You know, it's like, here's the problem. If you're borrowing more money than you're lending and you have a lot of debt, you either are going to pay back in hard money or in soft money. And so it creates a very difficult trade-off. So what can you do? Do you spend less money? So that the trade-off becomes more and more difficult. And that's what brings about a stagflation environment, because they tried to navigate between those two undesirables. In other words, they want to contain inflation, but too high of an interest rate that's good enough for inflation causes too much economic environment. So what can they do? No, they're in a position already because of that dynamic, spending more than they're earning, creation of a lot more debt, and a lot of other debt, which one man's debts are another man's assets, and that as the holder of that assets is losing money. Imagine holding a bond now, and look at how much money is in bond funds and cash. Okay, not only in cash, you don't get any return to compensate for the interest rate, and in your bond fund, you get negative returns. And how's that feel? So you're going to continue to hold those bonds in that bond fund? It's a dynamic that they have to deal with that is really beyond their capacity to deal with it. They can't change those fundamentals.
So is the soft landing just pie in the sky stuff?
When you say soft landing, there's no going to be, it's pie in the sky stuff. I think that most likely what we're going to have is a period of stagflation. And then you have to understand how to build a portfolio that's balanced for that kind of an environment.
Where there's the topic du jour today, or right now, is this inverted yield curve. Are we making too much as that being a predictor to future recessions?
Not too much. No, it changes. There's a whole relationship between cash, bond yields, and equity returns. So every investment is an exchange of a lump sum payment for a future cash flow. And so the cost of money is a consideration based on relative to the return on money. And so when we look at that return, when we say I can hold cash or I can hold a bond, that changes the inclination to hold cash. But also, one has to look at the expected return on equities. In other words, one calculates the present value of future cash flows. You estimate what are those earnings going to be in the future, and what are they worth today. And so stocks are now having expected returns, which are not very much more than bonds, which would be not very much more than cash. So as that happens, so that why should I own equities farther out, and have the volatility of equities? So that shift in the curve, in other words, the relationship between cash, bonds, and then the relationship between bonds and equities, and the relationship for corporations have a pervasive effect on the economy and the markets. So no, it's important to take a look at that relationship, that yield curve structure that way. But you should go beyond that and include the returns of other assets. What can you do in the way of generating returns relative to the costs of money, the relative attractiveness of those instruments?
Last one. I know you're a very busy guy, and I want to leave people thinking a little more about this. Tying back to your posting on YouTube, does redistribution of wealth, does that help solve inflation? Does it help keep countries moving from success to failure?
You have to have an economy in which the people believe that you have a fair system, and you have to have productivity. So I would say the most important thing, eliminate the internal conflict, or to reduce the internal conflict, which can be so disruptive. When you see large wealth gaps, and at the same time you see economic problems, you have a lot of internal conflict, and that internal conflict is bad economically and it's bad socially. So yes, I think it, but it's not just the wealth gap, it is the productivity level that results. So yeah, the wealth gap is a problem, the opportunity gap is a problem, the productivity that allows, and productivity can be measured in what you earn relative to what you spend. So yes, all of that, that gap is an issue, and it's certainly going to be a political issue. So when we talk about markets and the economy and all of these things, we have to realize, for example, that there's a great internal clarity is becoming greater. It's entirely possible that neither side, in other words, that we lose, though that, well, the democracy, in a sense, you could find ourselves in a situation where the rules no longer apply because of that type of internal conflict. Internal conflict will have a big effect.
We'll leave it there. I know it's very rare to get this much amount of time with you. We greatly appreciate you coming back on Yahoo Finance. Ray Dalio, always good to see you. Stay safe. We'll talk to you soon.
Thank you.
Over nearly 5 decades, hedge fund billionaire and investing legend Ray Dalio has built an iconic set of principles for how to thrive in the market and in life. He made his first stock pick at age 12 and at 26 launched Bridgewater Associates. Now it's the world's biggest hedge fund with about $223 billion in assets under management. His new book is called Principles for Dealing with the Changing World Order: Why Nations Succeed and Fail. On this episode of Influencers, Dalio joins me to talk about what's behind all this inflation, how the US-China standoff will unfold, and what it all means for the global economy and your portfolio. Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Ray Dalio, founder of Bridgewater Associates and author of a new book, Principles for Dealing with the Changing World Order: Why Nations Succeed and Fail. Ray, nice to see you.
Nice to see you.
So you've identified 3 trends in your book that lead to the decline of powerful countries, maybe like the United States, financial markets that lead to a lot of debt, internal conflict like political polarization, and pressures from the outside like rival countries. Let's start with the first one, financial markets. You've expressed concern about low interest rates that often lead to higher debt burdens and inflation. Would you say that characterizes what's happening in the United States right now?
Well, let me clarify. The 3 things that you mentioned are financial conditions, the production of debt and money to monetize those, the internal conflict over wealth and other things, politics, the greater extremism, and then the rise of a great power to challenge an existing great power in the form of China. Those 3 things never happened in my lifetime before, but they happened throughout history. And when I learned that, to be surprised, I knew that I needed to study prior periods. The reason we anticipated the 2008 financial crisis was because we studied the Great Depression. And so to answer your first question about the first of those, I view it just very much mechanically. Buying power, which comes in the form of money and credit, when that's produced in a quantity which is much greater than the incremental production of goods, services, and financial assets, drives those financial asset prices to go up. And the printing of money, the monetization of debt, is a last phase in a long-term debt cycle because it indicates that when there's a lot of debt and there's a 0 interest rate and you print that money, that debt monetization has its effects. So what we're seeing now in the market is very, very, very classic. It's happened repeatedly in that enormous amount of buying power created by the creation of money, which doesn't raise living standards, that is passing through the system. And so you're seeing it happen in the inflation of goods, services, and financial assets.
Right. So many credit a similar strategy with softening the COVID-19 downturn and helping speed up the recovery. Has the Federal Reserve been too dovish? And should they raise rates more quickly than they're indicating they will?
There's a trade-off that I think everybody has to understand, and that's related to the second. With the large wealth gaps and large not enough money in lots of places, the Federal Reserve and the Treasury were put into a position of needing to get checks out. And there's also this left-right conflict issue having to do with the wealth gap. And that means that you have fiscal policies that are now requiring lots of spending. And so the question is really, are the consequences of not doing that better or worse than the consequences of doing that? Now, when we look from an investor's point of view or an individual's point of view, we have to remember that you can't raise living standards by just creating money and credit, particularly if you don't raise productivity more than that. And that means that those asset prices are going up. So we're in the phase of the cycle, very classic, that the financial asset prices have gone up because you've given them more money, that demand is going up, and now we're having inflation of those assets. So if a lot of that buying power is going to be pulled back, particularly as we go into the next year. But there's still going to be a lot, and there's still going to be a high level of inflation of those types of assets. So the trade-off is always the question.
Right. Okay, so quickly, where do you come out on that trade-off? Is it a binary yes or no?
It's a reflection of the state of where we are in the cycle, that we have borrowed. It's all the problems that we've gotten ourselves into by acquiring too much debt and spending more than we're earning rather than being more productive, and also not distributing the opportunities and the incomes in a way that it's a broad-based prosperity. So on the one hand, you have a prosperity that the bottom 60% of the population isn't participating in very much. And at the same time, you have, so it's creating that polarity. And at the same time, you have the financial markets. So those are trade-offs that, different people, the only thing I care about is whether we're productive, whether we increase the size of the pie through productivity and then divide it well so that you create something closer to equal opportunity that produces greater political stability and also draws on the population going wide. And the reason I say that is because I've studied these empires, these dynasties, going back since the last 500 years. And you see the same thing happening over and over again. When there's a financial problem, when the granaries are empty and the coffers are empty, they print money. And when they print money and the coffers are empty, it devalues money. And with that, when you have a large gap of people at each other's throats, then you create a risk of an internal conflict, a risk of some kind of civil war. And that is what I think is we're at risk of.
Yeah, I want to get to that polarization in one sec, but just quickly on inflation rate, how concerned are you about it?
I'm significantly concerned about it because the amount of money and credit that has to be produced and is budgeted is a large increase. And yet, if it's not spent, it produces its own problems. The markets have a sensitivity to that. So what it means, and then there's a supply-demand picture for bonds. And the way it looks is if you should get the selling of bonds, it worsens that supply-demand picture because the way it works is the Treasury borrows and runs a deficit, but it can't produce money. So it has to sell bonds. And when it sells bonds, if there are not enough buyers of those bonds, then the Federal Reserve got to come in and print money and buy those bonds. And the world right now is over invested in US dollar denominated bonds, pension funds on the 60-40 mix, and they have negative real returns. And cash has a lot of negative real returns. So if there was a selling of that and a moving to other assets, stocks, other assets, commodities, other assets, or other places, other currencies, other real estate and the like, that selling worsens the supply-demand picture. And then if there's not enough demand, that means that the central bank has got to come in and print more money. So yes, it's not only the inflation that's in the pipeline or projected in that supply-demand balance, but it's also what it could be if there's a selling of debt instruments.
So we're printing too much money?
It's going to produce inflation, if that's what you're saying.
Right. Okay. Let's go to the second trend you identify in declining empires, internal unrest. You write that wealth inequality often leads to the rise of populism and division. How bad have the divisions gotten in the US, and what's most to blame for that?
Well, I think people around us, we all see it. January 6th was just a simple, but history has shown when the causes that people are behind are more important to them than the system is in jeopardy. And what we're seeing is not a classic wealth gap caused by, accompanied by political gaps. So you're seeing that the left is more left and the right is more right. And you're seeing the conflicts within the parties. In the primary elections, you're going to see in each party a competition between the moderates and the more extremes. So you're seeing that dynamic play out. You're seeing questioning of election results and questioning of rules. So you're getting to the point. Something like 15% of, I forgot whether it was Democrats or Republicans, wish the other member of the party would die, and 10% of the other party wish they would die. They don't want their children to marry other members of the party. So there's a question of even how rules will be followed. And so there's going to be a conflict. And I think it's not an exaggeration to say that you could see in the 2024 elections that no side will lose, and accept loss. And you're seeing the movement to different states related to different values. These types of things have never happened before, but in my book and my study that I did to understand them over time, they happen repeatedly through history. So I'm not just looking at what's happening today, but I'm finding that that pattern follows a very classic pattern that's repeated throughout history, which is the tendency of the middle to disappear, and that you have to pick a side and you have to fight for that side. And that's the dynamic that is what I think is going on and following the classic dynamic that's shown in the book to have happened repeatedly.
In the book, you cite the emergence of figures like Elizabeth Warren on the left and Donald Trump on the right. But Ray, do you think there's a risk here of drawing a false equivalency by framing it that way? Because Trump made concerted efforts to overturn the 2020 elections, whereas Elizabeth Warren wants higher taxes and more regulation.
I don't understand why that's a question. I'm very much a mechanic. I'm not a ideologue, not ideologically. I just take measurements. What I'm saying is that if you look at the voting records of Republicans it's the most conservative that it has been. If you look at the voting records and policies of Democrats, it's the most left that it has been. And that if you look at, this is since 1900, if you look at the voting across party lines, it is the lowest that it has ever been. So that you have, those are just simply facts. You have a party in which basically something like 30% of the population is in support of let's call it the more right, let's say the Donald Trump more right, and something like 30% of the population is concerned with the more at the more left, and that within each party that there is then a conflict between those two things, and that because of that constitutes perhaps the majority of those party members, then those that are in the middle, although they would constitute a higher percentage of the population, still let's say that swing 40 or 50% of the population, they within their parties are not dominant, and as a result, we're seeing that move to the more extremes of the two and the greater conflict.
Fair enough. I guess I was just, making the point that there's left wing, right wing, extreme left, extreme right, and then there's just not believing in facts. But I get it. You write that the U.S. has a 30%.
That also is through the history. It's very interesting. You read these things. The combination in history of politics and the media operating with the emotions has been a classic dynamic that's repeated over time, the dynamic that we're seeing now, so that the media tends to become more polarized and more appealing to those who want to fight with each other. And then distortions in the media, because fighting and winning is more important than seeing both sides. And that's why the distortions that take place, and that greater polarization in the media is very, very classic. You see, and then you lose that medium.
Right. I don't want to go down this rabbit hole, but explaining that the big lie is just that, maybe isn't polarization. Maybe it's just trying to get people to see facts. But
I think that by any measures, a sense of we're getting facts through the political system and the media, the public's readings on that are the lowest on record. So I don't think it's the getting of facts. I think there's a great concern about the inability to get the facts. And that, I'm saying, you see that in all the histories of, it's recounted in the book many times, that you see that dynamic working because everybody becomes polarized. But yeah, no, I don't think that we would cheer on the efforts to get the real facts.
Good. You write that the U.S. has a 30% chance of devolving into a civil war within the next 10 years. What would cause that to happen, and who would be responsible for that?
Well, let me clarify what I mean. What I mean is that fighting over the rules, it doesn't mean necessarily shooting each other, although you could see much more violence. It means that the rules of the system, that democracy by rule of law, and the deferring to what the rules are, for example, to settle elections or settle issues, I think that that could be largely lost. I think, for example, like they had sanctuary cities, you could see situations in which the federal government would give mandates that would not be followed by the state governments. And then there's a question of how you just have power and who has what power. And I think that you're going to see a lot more tested through the legal system, and then maybe even beyond, that they won't accept those rules. And then that's a threat to our democracy, because the great thing of our democracy is that they're following the rules, believing in it. I mean, we've seen repeatedly where a presidential candidate might have the majority, but they said there's electoral votes, and it comes down to that, and then the following of the rules that our system's dependent on. And I think that almost anybody looking at the situation would say that there is some significant probability that might not work as well.
You talk about wealth inequality as an attribute of declining empires, but you contrast the US with a rising China, which also has a very large disparity between rich and poor. Why is wealth inequality concerning in the case of the US, but less so when it comes to China?
Well, it has nothing to do with China or the US. It has to do with the nature of the phenomenon that you see across countries. It's not, if you have a large wealth gap or opportunity gap, and you have rising living standards, you don't have the same kind of conflict risks. It's the three, when the three work together. When you have a financial problem, and so you can't resolve that easily, and then you have the conflicts, and they can be over wealth. That's the left-right conflict. But there are other conflicts that end up, it could be, we see it about groups, that people tend to gather in groups. It could be ethnic, it could be whatever. And so you see that when you have that, and you have challenges, other challenges like the rising power challenging another, there's more tension. And if you start to have lower living standards from that and a sense of inequity, it produces more conflict. That's happened repeatedly. That mix has happened repeatedly.
Let's go to the third trend that you write about in your book, which is the external threats, which in the case of the United States, you see mostly as a rising China. You say China is on its way to overtake the US as the world's most powerful country. I guess the question is, why, and is that inevitable?
Well, the population of China is 4 times that of the United States. So if it has an average income of half the United States, it will be twice as large as the United States. When I first started to go to China in 1984, since then, its income real income has increased by 26 times. So if you just extrapolate lines and you look at productivity and the like, it's a very likelihood that China will be, it's today a comparable power in many ways, and that it would become a greater power. That's just how things are transpiring. And if you look at history, China has a history of being, prior to 1800, always, like number 1 or 2, because it has a large population and it's been very productive historically.
Bridgewater invests in China, as do many other funds and companies that do business with that country. But you and others have drawn criticism for, I guess, profiting off the rise of a country challenging the United States, and at the same time acknowledging human rights violations committed by China. How do you respond to that, Ray?
Well, every company, every investor has to balance the interests of various parties. So, for example, I have a responsibility to the investors. And then if there's not connections in its ways, companies, if they were separated, all these companies dealing together, if there was a separation, that means that it would not be efficient for the whole system. And so what we're looking at is guidance really by governments who understand all the issues, geopolitical issues and the like, to try to balance those issues, the constituencies and so on. So that's really our expertise is in investing and is in economics. And we think that as we will assess what percentage of the portfolio should be there. And we do that in 40 countries. When we think we invest in Brazil and many, many countries. And we have to rely really on the guidance of not only our country, but the countries that are there, because it's not just a matter of what we individually think. It's a matter of making the right decisions based on the people who are in the responsibility of assessing them, make those decisions.
You know, things have changed so much over just say the past 5 years. I mean, it used to be yourself, people like you and John Mack, Hank Paulson could be described as friendly to China. And now, you know, that description gets more difficult. You've got Mitt Romney calling you out, you know, Fox hosts calling you a collaborator. Does it trouble you that this has changed so much, our relationship, and how people view the relationship and how you are a part of that relationship, Ray?
What me, I could deal with me. What does trouble me is that both sides really don't know each other well. And it strikes me as a very inclination to be emotional and to fight. And that raises the odds of a fight on both sides. And it's almost a needless fight. I mean, there are things that you have to say, what will you fight for? And what are the consequences of that fight? So I believe in peace. I mean, that doesn't mean you shan't, when your essential values yourself are threatened by an outsider, I think you have to fight for that. But the inclination to immediately stereotype and fight rather than to try to seek what are the other side's perspectives, and that demonization is a dangerous thing that could bring about a war, and a needless war.
How should we, though, Ray, respond, we being the United States, respond to the rise of China, either positively, negatively, carrots, sticks? What should we do?
I think that there are 5 types of wars. The first 4 are competitions, really. There's a trade war, a technology war, a geopolitical influence war, and a capital war. Those can be viewed as competitions. And then there's a military war. In all of those cases, the most important thing that you can do is be strong. Us, internally. If we do the right things to be strong so that we are stronger than any opposition in the world, we won't have a problem. So I think the biggest war that we're having is a war with ourselves, to be able to be productive, to earn more money than we spend, to improve our income statement and our balance sheet, and to be good with each other so that we're productive together rather than at each other's throats and threatening our effectiveness.
You say a military confrontation between the US and China is unlikely for now, but becomes increasingly possible as China catches up. What are some signs that we should see perhaps that would concern us?
Well, I think if there's going to be a military war issue, it is likely to be around Taiwan. I think other issues are not military triggering. And just the view of that is Chinese perspective and American perspective both, and the world has said there's one China, Taiwan's part of China, and they should have peaceful unification. That issue is a diplomatically worded issue, but it's an important issue that might be, could be fought over. I think that you watch it. You watch the news, you keep on top of that, and you see the actions. So beyond that, I think it's mostly the competitions in those other areas. Again, I think it's just be strong, but watch what's going on closely with Taiwan. That you'll see the straws in the wind.
Taking a step back, Ray, and looking at the big picture here, it sort of suggests, at least my take on the book is that, wow, you're writing about, and you're saying empires in decline. You're writing about the U.S. in decline. Is that the case? And is it inevitable? How bad could it get? How can we turn it around and have it not happen?
I express very little opinions in the book. I do express opinions, but what I thought was very important was to have objective measurements. So you see 18 different gauges that include a variety of measures of relative strength. Measures such as education, productivity, building of infrastructure, how many inventions come out of the country, many different measures of performance. So those objective performance measures are the most important thing I could get across. So anybody can watch those. They're like a health index. You can see if the levels are going improving or deteriorating, whether the income and balance sheet thing is improving, any of those. So it was most important to me not to be ideological or opinionated. I don't think my opinions matter as much as the reasoning behind that. And that's why I put those in and also created a model that has a cause-effect relationship. I looked at 10-year leading indicators of output. In other words, everything that happens has causes that make it happen. And by being able to measure those cause-effect relationships and putting them into graphic and numerical form, and then using those to then give an indicator, I could show what happened, and that's what my objective was. So the reader of the book will be able to make their own judgments. What you see in the book are really those measures over time, repeatedly through the rises and declines of empires.
We are almost out of time, Ray, but I got to ask you before we let you go about crypto. You told CoinDesk you own some, even though you said you thought it was going to get killed by regulation. How much Bitcoin do you own? Do you have any other cryptocurrencies? And what do you think the outlook is for them now?
Well, I'm not going to give the precise amount of Bitcoin, but I do own some Ethereum as well. But the answer to your question is that I don't own a lot of it. I view it as an alternative money in an environment where the value of cash, money, is depreciating in real terms. And I think it's very impressive that for last 10, 11 years, that programming has still held up. It hasn't been hacked and so on, and it has an adoption rate. So I'm very big on diversification, and it's a relatively small part of the portfolio. I would like to say that cash, I've been quoted, cash is trash, that cash, which most investors think is the safest investment, is, I think, the worst investment, and that it's important because it loses buying power. The one thing I would say to investors is don't judge anything in your returns or your assets in nominal terms, in terms of how many dollars you have. View it in terms of inflation-adjusted dollars. And so cash, like this year, you'll lose 4 or 5% to inflation. And so pay attention to those, because I believe that that'll be the worst investment. And then beyond that, the important thing is to diversify one's portfolio well, because we know from that the surprises in the balance. We also know that those asset classes on average significantly outperform and will significantly outperform cash, and that they move between each other in a way that that has to do with correlations, because of when things go down, when the economy goes down, then bonds will do better than stocks, and so on and so forth. So diversification of assets. I view crypto as a small piece of that. And the message is cash is going to be a problematic asset, and hold that other diversified portfolio of assets. Keep looking at it in real terms, not nominal terms. And that diversification should be also international diversification from countries, not just asset classes, in order to have a truly well-diversified portfolio.
All right, Ray Dalio, founder of Bridgewater Associates and author of the new book, Principles for Dealing with the Changing World Order, Why Nations Succeed and Fail. Thanks so much for joining us.
My pleasure.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Finally, the end of the pandemic is in sight, but the uncertainty about what comes next and who will benefit has thrown the market out of whack. You can be sure Ray Dalio sees through the chaos. Over nearly 5 decades, the hedge fund billionaire and investing legend has built an iconic set of principles for how to thrive in the market and in life. He made his first stock pick at age 12, and at 26, launched Bridgewater Associates. Now it's the biggest hedge fund in the world, with about $150 billion in assets under management. On this episode of Influencers, Ray joins me to talk about what the COVID-19 stimulus will do to the stock market, whether the government could outlaw Bitcoin, and what worries him about a wealth tax.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Ray Dalio, founder, co-chairman, and co-chief investment officer at Bridgewater Associates. Ray, welcome.
Good to see you, Andy.
Let's start right in and talk about the markets, Ray. There's been a tremendous amount of volatility this year. Why is that happening, and how do you expect things to pan out?
Well, it's simple. You know how the thing works. If the pulse of the economy goes down, then the policymakers, like doctors, rush to the patient and inject it with a whole lot of stimulation. And so what they did is they wrote out a bunch of checks, and they're writing out a lot of checks, which are about 7 times, 5 to 7 times the size of the hole. And they got that money out. And what that did was, of course, the government doesn't have money. They can't print money. So they have to borrow that money. But the Federal Reserve can print money. And so the same thing that is happening like on March 5th, 1933, is the same thing now in terms of that big stimulation. So the way it works is real interest rates are so bad, money's so cheap, and it's so abundant that it changes a lot of financial assets, and it causes those financial asset prices to rise. And when they rise, future expected returns go down to start to approach those of bonds and the risk-free return. And so that's what we've gone through. So you see it domestically, you see it also in the currency, in the dollar, you see it in other assets, gold, Bitcoin, and so on. So the world has got a lot of liquidity. And now we're in a spot where we're going to have the supply-demand question. The big question is the supply-demand question, because we're going to have to sell a lot of debt. And I don't know if you want me to go into that, but we're going to have to sell a lot of debt. And then the question is how that goes. Will the demand be there, or will the Fed have to monetize more? That's the dynamic.
Yeah, I do want to get into that debt question. But first of all, I want to go back to stimulus, which maybe is before that. And am I to understand then that you think there's too much stimulus coming from Washington at this point, Ray?
It depends, like you say, too much for what? Too much for the supply demand? Mm-hmm. Yes, probably. Okay, we'll get into that. Too much because like fast, a lot of people needed to get a lot of money. Okay, if you look at the needs and a lot of things like, okay, err on the side of too much. There was, you know, we have a big wealth gap. We have a big opportunity gap. We have big gaps that are issues. We see it here. I work, my wife, particularly in the state of Connecticut, works with disengaged and disconnected students, high school students in poor neighborhoods and so on. And you see their conditions and what the budgets are. There are a lot of needs. So I'm not saying the needs are not there. I'm saying just the way the machine works, the reality of it is, you know, you're making this big supply demand move, but that it's not like it doesn't have risks and costs associated with it. So from the market's point of view, it's a real big deal.
Yeah. So does that mean, you know, you sort of flood the zone to mitigate and obviate these sort of social problems, and sort of by definition, you're going to overshoot, and then we have to deal with those consequences?
Yeah, because like debt, at the end of the day, it's going to be one way or another. It's either going to be when somebody borrows and you're using that debt, is that going to produce productivity so that in hard money terms, that money can be paid back in a way where, okay, it paid off in a productivity increasing way? Or is that not going to be paid off? And somebody's always going to pay, but it's going to be the bondholder, it's going to be the cash holder who is going to pay if that doesn't come back with real productivity. And right now, it was an emergency situation with COVID mixed with a political situation to disperse a lot of money. And that's what we have. But it's not ending there, because that's the new policy.
So can I infer then that you're suggesting we're going to have an inflationary period ahead because of this, what you're just outlined?
There are two types of inflation. Okay. Let me just clarify. There's supply demand inflation, like if demand is pressing up against capacity to produce things, and maybe that's labor, maybe that's capacity constraints and so on and so forth, prices rise because of that. And then there's monetary inflation. And monetary inflation is because the currency and the value of money goes down. And so you can see, like in the 1970s, stagflation. You could see inflation is not coming from the first of those types of inflation. It is coming from the second of those types of inflation. And the way that would occur is because people don't want to own bonds. To me, it's pretty crazy to want to own cash or bonds. Okay, we can get into why that is. But if you have that movement out of like that type of financial assets to other assets, which we are seeing, then that has the effect first of causing financial inflation. In other words, an investor shifts it to another investment and they go up in value. And then that wealth effect has an effect on those items that people who acquire the money want to spend on. So maybe it's on penthouses, or maybe it's on something else, but it depends how that's spent. I'm more worried about the monetary inflation, which would look something like a currency defense. It means that what happens is, as money, let's say people don't like bonds, and then they start to sell bonds, and bonds then go down in value because they have a capital loss, and they don't offer anything in interest rates, negative real interest rates and so on. They don't like that. Then the Federal Reserve or other central banks are faced with the choice of either rates rise, and that is bad for financial asset prices and it's bad for the economy, or they make the purchases. They make money and they make the purchases of that. And that then produces more of a monetary inflation. So it's the second that I'm more concerned with. But the supply demand of debt will be, I think, the big driving influence. And I want to emphasize this because so many people say, okay, well, here, they look at this stock or they look at this. But what you saw was the V bottom in all markets and so on. And that was due to debt and money dynamic happening. So that's the biggest dynamic to pay attention to.
So wait, that V bottom, do you mean a year ago?
Yeah, that's what I'm saying. You could I think it was April 8th or 9th. Mm-hmm. The exact same action was taken basically almost as happened on August 15th, 1971, which was also the exact same action which was taken on March 5th, 1933. In other words, the big jolt, the separation in terms of that value of money, that dynamic. And that is the new paradigm.
And so what does that mean? So on the one hand, you're seeing this rotation in equities from growth stocks to cyclicals. Number one, is that going to continue? And then number two, the 10 years up, 100 basis points this year. Is that going to continue?
Well, what's happened is that a lot of, like these cycles go, a lot of new ideas, new technologies, new things come along, and they make fabulous revolutions, and they grow things, and that's great. But there's a tendency of investors to extrapolate the past and get and not pay too much attention to price. And when that happens, you start to emerge as somewhat of a bubble. By our measures, the bubble is not as what it was in 2000 and not what it was in 1929, but it's kind of like halfway there if I look at the types of qualities. In other words, and so what that means from a value point of view, if you're calculating, what can I realistically expect? Its expected returns shrink relative to the others. However, the kind of the meat and potatoes type of companies didn't benefit as much from those, and they're fairly stable and so on. And so that's why you're starting to see that kind of rotation. Now that can change. It can come and go in these phases, like when people get stimulus checks and then, they might be hot on, the exciting things and they run up again and so on. But that's going on. And of course, there's Bitcoin and other things that are going on. However, the big thing is plenty of liquidity and ridiculously low interest rates. Now, you ask about the 1.6%. I think we have been in a 40-year bull market in bonds. So now you look at that 1.6%. That's a negative 1% about real. Okay, so you're guaranteed. And you ask yourself, if you're going to hold a bond, any investment, the only purpose of an investment is so you can sell it to buy something you want. And so when you look at what is the length of time it's going to take me to get my money back, if I give an investment nowadays in the United States, I'm going to have to wait about 50 years to give back the buying power to start, and then I'll start earning money. If I'm in other countries, some Europe and Japan, I will have less. And if I measured in all those countries in real terms, I'm going to have less money. So basically what that means if I just bought anything that didn't depreciate in real terms, if it just matched inflation, I'd be better off than to have those things. And so now, I don't think those rates will only stay down there, I think, if the Federal Reserve does what it did like in the 1930s in the war period, which is to put a cap on rates, to make short-term interest rates low in relationship to the cap. Like back in the 30s and the war years, they made 1% was the short-term interest rate and 2.5% was the bond yield. So it was profitable to buy those bonds, funding it with 1%, and you got 2.5%. That could put a lid on it. But because those two assets, cash and bonds, were such bad investments relative to other things, there was the movement to those other things still. And then the government outlawed them. I mean, things like gold. They outlawed gold. That's why also outlawing Bitcoin is, a good probability. And that they also established foreign exchange controls because they don't want the money to go elsewhere.
Let me jump in, Ray, because that comment you made about Bitcoin, I mean, so it's a two-part question. Is that in a bubble? Maybe three-part question. Is it dangerous? And what do you think the likelihood of the government outlawing it is? And is that even feasible?
Bitcoin has proven itself over the last 10 years. It proved it hasn't been hacked. It's by and large, therefore, worked on an operational basis. It has built a significant following. It is an alternative, in a sense, storehold of wealth. It's like a digital cash. And those are the pluses. Bubbles are financial assets that have imputed value. It's an asset that doesn't have intrinsic value. It has imputed value. It's whatever we think it is. And if you look at some of the bubbles in the past, a great book is Extraordinary Popular Delusions and the Madness of the Crowds by McKay, 1845 or something. But he talks about the South Sea bubble, and he talks about the Mississippi bubble and so on. It is when people love it. It's the dot-com bubble and so on. And that could be. So when you look at Bitcoin, it's a possibility. It's an alternative because there aren't many such assets. There are not so many assets that might have intrinsic value that can't be messed around. As far as the government allowing it, the history was, banks always used to exist. And then with the Bank of England, they decided that it was in their interest to have a monopoly on banking at a country. And so what we did is every country treasures its monopoly on controlling the supply and demand. They don't want other monies to be operating or competing because things can get out of control. So I think that it would be very likely that you will have it under a certain set of circumstances outlawed the way gold was outlawed. And you're watching that question arise in India today. India today is making the move to outlaw possession of it. Okay, so we have to see what that means. Now, can they do it? Now we get into the particulars. My understanding from people who are sort of in government surveillance and go on is, yes, they can understand, they can track it, they can know who's dealing with it. I don't know, I'm not an expert on that. But there's a whole way, is it private wallets? Is it not private wallets? How do you do this, and the other thing? I would suspect it would be very hard to hold up against that kind of action. So that's what it looks like to me.
Right. What do you make of, how do you assess so far the Biden administration, the president, and in particular, Janet Yellen?
Well, I'd say politically, it's a reality that there are two political parties. In both cases, that there are rather extreme elements to that. We can call it capitalist and socialist, or we can call whatever we want to call it, but there's a range. And there is not much in the middle. It's difficult to be in the middle because they have to align with either of those. So in terms of, let's say, economic policies, generally speaking, there's not much, it's tough to fight with both your Democrats and the Republicans. And what does that mean? Things like the wealth tax might be a litmus test. But in any case, I think that there is a big movement to deal with those gaps I'm referring to. So we should expect significant increases in taxes and so on in various ways. We can get into a discussion about that if you want. And depending on whether that's done smartly or not, will affect the markets. For example, when we cut corporate taxes, that benefited stock prices. Depending on how the tax rates are changed and so on, that will certainly affect asset prices and capital flows.
Let me ask you about the wealth tax. Tell us what your idea of a correct wealth tax would be.
I'm a mechanic. I'm not an ideologue. I'm basically somebody who basically thinks if you move the lever this way, what will happen? That's basically it. Yeah. What I did was do a study of all the cases of wealth taxes in different countries that have existed, and look what happened at those. And I passed that along. I didn't comment on that, but there are facts, which is like I looked at 33 cases, and in none of those cases were they sustained and raising a significant amount of money. Mm-hmm. In some cases, like Switzerland has a wealth tax, it's a very small tax, and it was sustained. Norway has a tax, and it was small, and it's sustained. Those that are big haven't lasted because of a variety of reasons. They're operationally difficult and so on, illiquid assets. I won't get into all that. But there are different types of ways of taxing wealth. And so you'll see, I think you'll see the easier ways to tax wealth become more popular, such as stepped up basis. In other words, nowadays, when you die, you get if your assets appreciated, you don't have to pay the capital gains tax on that and the inheritance tax. I think that's probably in jeopardy. And I think that you'll find different other types, property taxes, other things, they may come about. But that's my thought on the wealth taxes in general. They also have the big risk is this an environment that's hospitable for capitalism and capitalists? That affects capital flows a lot. And it's not just affecting American capital flows. Americans think it's just Americans. No. Foreigners own way more bonds, American bonds, than Americans own. So just the whole notion of where to go, where it's safe market for capitalism and capitalists has an effect on capital flows. So those are the mechanics.
Speaking of foreign investors, Ray, what is your take on our relationship with China right now, and how do you perceive it moving forward?
Well, every empire rises and declines. For those who are interested, I studied this. I needed to study for reserve currency, so I studied this going back 500 years, and it's on LinkedIn. It's called The Changing World Order. You could see the patterns, and you could see what's happening. China has gone from, I started going there 36 years ago. They were dirt poor. I would bring a calculator and give it to gifts like CEOs, and they thought they were miracle devices. Now they are, in many ways, in AI and quantum computing and so on, at a comparable type of level. So China, by all measures of its power and prosperity, is a very, very strong competitor. So now you have the leading empire. 1945, we created the American world order because we won World War II. And so we had a new monetary system and so on. And now we're having a challenge of that, partially because of Chinese, but partially also how we're handling ourselves. I mean, we're not doing great in handling ourselves in a lot of the most basic ways. So yes, we have that conflict. In China's, I would say it's I've had a lot of contact there over decades, and I really believe it's an evolutionary process. There are certain things from the Chinese perspective. They would believe if you can't suppress or compress me, that would be their view, that the United States is trying to do that. I suspect there will be tensions. And the question is whether, one side becomes too confrontational to let evolution take its course. But it's true that evolution is more on China's side than our side, although it really depends whether we can get our basics right. And our basics are things like broad-based public education, the quality of education, civility of the people. Do people work together in a civilized way, or are they at each other's throats? And innovation and those things. So China is a very exciting place. If you spend time there and you see what's going on with entrepreneurship, the creation of new businesses, new investment in things, and there's an energy, and it's quite something.
Let me ask you a couple of questions about Bridgewater and about you, Ray. First of all, Bridgewater, it was a bit of a choppy year last year for the firm. How are things shaping up this year? How's David McCormick treating you?
Oh, David's a star. So yeah, you're referring to this transition, which is, I think, the most beautiful thing. It's not easy to start off and make a founder-owned company, let's say, founder company, to then be able to transition and to be sort of a mentor and CIO, but and to let the talent rise. And I'm very, very, very lucky to have Dave McCormick in that role. And we have a team. The investors, Bob Prince has been with me, I think it's been 34 years, something like that. Greg Jensen's been with me for 26, 20, I don't know, a lot of, decades. We will fight like hell, but we're together and so on. And so I'm at 71. And the most beautiful thing for me is to complete that arc. And, that's what we're doing. We're doing it together. So it's doing great, and we're learning. But you're right. The second quarter, the pandemic caught us. We, in prior years, we never had, I don't know how many years we had no losses. And again, there's an alpha fund and a beta fund. But anyway, in the first half. But for the most part, that all rebounded, and we learned a lot. So I think it's good. I think it's good on all of those fronts.
What about some of the thinking that you're now famous for, Ray? Meditation, radical transparency, your principles. Have any of those changed in recent history, maybe because of the pandemic, changes in society? What is your latest thinking when it comes to some of those facets?
Well, I just want to, the things you mentioned hasn't changed at all. And I really want to pass that along. At my stage in my life, the main thing I'm doing is want to pass things along that have been valuable to me. I mean, that's why I'm doing the interview. And so meditation, wow, that has, I started that about 50 years ago, and that has given me the equanimity when things come at me to deal with those well. It also gives creativity, because one goes into one's subconscious, and that's where the creativity comes from. It's like if you take a hot shower, the great ideas come to you, and it's not because you muscle it. So that's been valuable. And this, the Bridgewater, the culture has been and is an idea meritocracy. In other words, let the best ideas win out, in which the goals are meaningful work and meaningful relationships. So you're excellent at the work. And then also, if you have the relationships, that reinforces the work and it reinforces, and the mission with people you like and you care about, that's powerful. And through radical truthfulness and radical transparency. Radical truthfulness means like we're going to be totally honest with each other. It may be brutally honest, but misinformation, because you've got this scenario going on in your head, but you don't really know what the other person's thinking, is dysfunctional. And it also means that you don't build trust. If you're in a political organization and that guy's acting really nice guy, high five and so on, but it's not going on the same behind the scenes, that undermines trust. So those have been the things. The thing that I learned the best, and I learned from failure. I learned from my failure. 1982, I expected a big debt crisis that was going to cause problems. That was the bottom in the stock market. I couldn't have been more wrong. And that gave me the humility to realize that what I think in my head, or what any one individual thinks in their head, might be wrong. And the markets help you understand that. And so the idea of having others stress test each other with that radical truthfulness and that strategical transparency raises the ability. So I'd say whatever Bridgewater's success has been, it's been because of that way of operating.
It's a good segue to my final question to you, Ray, and that has to do with your legacy. Would you want to be known as a thought leader or as an investor, or maybe it's both?
I don't care what I'm known as. I don't think anybody will actually remember anybody, because think about like how many people do you remember from a generation ago? Think about the rock stars, the movie stars, the other famous people. They all disappear. We all disappear. The legacy, the way I view legacy, is what is the gift that you're passing along? And the things that I want to pass along in that are these kind of principles, like how does the machine work? How does reality work? And how does one interact with reality to get what one wants? Those are what I mean by principles. And they don't have to be my principles. We're all on a discovery to try to find out what is reality, how does it work, and how do we interact with it well. And that's what those are the things. So I wrote one book, Principles. I wrote another book, which is Principles for Understanding Big Debt Crises. I'm writing the other ones, which has to do with the changing world order, those principles. And I'm writing these actually like for my grandkids. As well as everybody else. I've got them in mind. Like when I'm not around, it can almost deal with anything. When you're thinking about your job or whatever, here's some of the things that might be helpful. But most importantly, you should have your own principles and think about them well. So I pass along those principles, like pain plus reflection equals progress, and so on. Don't get caught up in your own head. Have radical truthfulness and radical transparency. Those are the most important things. Your approach to life, one's approach to life is the most important thing. And when you start to understand that each person has their nature, what do you know your nature? And then once you know your nature and you're on a journey to find your click, find the fit, that is the thing that allows your nature to flourish and deal with other people when they know their nature. Those are the most important principles, I think. That's what I'm trying to pass along. If it lives on me without ever me being referred to, that'd be great.
Okay, Ray Dalio, founder, co-chairman, and co-chief investment officer at Bridgewater Associates. Thank you so much for your time.
Thank you, Andy.
I'm pleased to bring in our next guest, Ray Dalio, the founder of Bridgewater Associates, the world's largest and most profitable hedge fund firm. Ray is also a well-known philanthropist and an author of multiple books. Ray, it's great to have you with us.
So nice to be here.
You wrote the book Principles, and it's a fascinating read. You're talking about radical transparency, thoughtful disagreement, all these different principles. And we're just having this conversation about, how we are with each other and civility, bringing back civility. Are you optimistic that we can get there?
I'm not optimistic that we can get there, but I do know that we can get there if people are fearful of the consequences of not getting there. I believe that if you study history and you see what civil wars can be like, and you realize that you could have a civil war, don't take it for granted that you don't, and you see that when people put winning and getting their way above all else so that they will distort truth, that they will cheat rules, and that they will be violent with each other because that winning is of paramount importance, that the whole suffers greatly and it affects everybody adversely. So, but I do think we're in a mindset in which everybody, not everybody, but I think the greatest problem of our time is people are passionately attached to their opinions and are not able as well to go through the thoughtful disagreement of how to get past those disagreements and do things well together.
I want to talk about capitalism as well. And I know, Ray, you've done a deep dive on this. You did a study on this not too long ago. And it also ties back to education, which I know you and your wife are intimately involved in the state of Connecticut, which if you look at that state has a wealth gap as well. How would you diagnose the current state of capitalism? Is it broken?
Yeah, the piece you're referring to, which is available on LinkedIn if anybody wants it, is why and how capitalism needs to be reformed. It's kind of simple. What are your goals? And is the system achieving the goals? I don't know that we could agree on our goals, but I would say the American dream, as I grew up and really believed in and benefited from, was the idea of equal opportunity. And in doing that, you would draw upon the greatest percentage of the population so that you would find out where the talents lie everywhere. And also the people would believe the system is fair. And so I believe when I look at that, I think the system is broken. I believe in capitalism, but the nature of capitalism in various ways can produce these disparities that has to be dealt with. So education is a good example. As you point out, my wife and I, and particularly my wife, sees kids can't have the most basic educational needs pervasively. Okay, let me give you the picture in Connecticut. Connecticut is the richest state in the country, and it has the largest wealth gap. And wealth is concentrated in a small percentage of the population relative to the whole. 22% of the high school students in Connecticut are either disengaged or disconnected. Disengaged means that they have an absentee rate which is greater than 25% and they're failing their classes. Or disconnected means they don't come to school, they're out of school, they don't know where they are. 22% of the high school students. Where are those high school students going to be like? What kind of citizens are they going to be? Are they going to be net contributors, or are they not going to be a net deficit? And is that fair? Okay. Education. We were in a situation where COVID makes clear that they didn't have computers. So we had to, and the state didn't have the money for buying the computers. So we had to buy 60,000 computers for kids who didn't have computers and they don't have connectivity. Okay. But there's so many, there's poverty, there's food as an issue in that kind of environment. So it's not an environment of equal opportunity. Now, why does that exist? And there are not bad people who are producing it, but the profit system is not good enough to be able to allocate resources that way. In other words, not everything's going to be able to be achieved by profit. For example, profit pursuit is logically, and for the efficiency of the whole system, going to replace people in jobs. And so it contributes to the wealth gap. It's smart for a company to have a technology that's going to replace people in jobs, but you get to a smaller and smaller percentage of the population that makes that technology and benefits it, and it produces that wider wealth gap. So that wider wealth gap also is an unjust system. What I found is that the top 40%, because I broke it into quintiles, top 20, each 20, and top 40% of the population on average spends 5 times as much money on their children's education than those in the bottom 60%. In other words, the majority of people has this, the elites spending 5 times as much money on their kids' education. The elites and the people below want to take good care of their kids. They're not doing a bad thing, but that perpetuates an opportunity gap. So those structural reasons, not any bad guys, but those structural reasons are leading to a result that I don't think, that is either fair or that we want, because we're not tapping that talent. And it could lead to a civil war or, some kind of revolution of sorts. So it has to be dealt with.
And you have to wonder, too, how the states are faring through the pandemic, too, when you're thinking about just the public education system and funding those things. How do you think that kind of exacerbates the problem? And what should be done? Do we need more government to step in here? Do we need the private sector to step up? Do we need more philanthropists to adopt the local public schools? What do you think needs to change?
Before I get to what I think to change, I want to build on your point of what is. And what is in a lot of places, and it's ironic, in the richest states, they have the most debt and they have the largest wealth gaps. So this is true not only in Connecticut, New York, New Jersey, Illinois, and a number of places. And that produces a dynamic that has been, everybody sees it's true over time. You can't raise taxes because people will leave and too much a burden. And you can't lower spending because it's inhumane for those other people. And when you have a large debt and you have a large wealth gap and you have a downturn, you have a conflict. You've got a real problem. The United States as a whole has that issue, but the Federal Reserve bridges the gap by buying the money, but printing the money and buying that gap, buying that debt. I think at the end of the day, the question will have to arise, will they have to do it? How will that question be dealt with? Because it, at the state level or the local level, because it exemplifies what happens when the debt can't be purchased. So I think we're in an era of a lot of monetization. Unfortunately, these all reach a point where it's an intolerable crisis. And then extraordinary measures come. And so I think that the path will look something like that.
So what does that mean for my generation? I'm a millennial. My generation, I guess we're becoming the parents of today, and younger generations, we're going to be the ones that have to really deal with the consequences here. What do you think the world looks like that we ultimately inherit?
Well, again, I think you have to be savvy of what that whole cycle is like. That's one of the reasons I wrote that LinkedIn piece. So the changing world order on LinkedIn, if you see it, because otherwise you'll be surprised by it, I think. But I would say when you're looking at that, it comes back to the same fundamentals. Educate your children well. Teach them self-discipline, character, civility, those things, to be strong. Teach them then to be open-minded, to go to read history or to hear from other people. Teach them to be strong. Those are the things that you can give. And yeah, don't be naive. Don't be blind to think that just the experiences that you've had are all you need. The future will be very different than your past because of the way these things go in cycles. The funny thing, I think most everybody expects the future to be a modified version of the present or what they've recently experienced. And more often than not, it's more the opposite than similar. In fact, if you take every decade, the 1920s, the 30s were the opposite. 1930s, the 40s were the opposite, more opposite than similar. And you take every decade and it's more opposites than similar. So open the mind to that. Strong character, well-educated. Those are the things at the end of the day that will serve you well.
Mm-hmm. You know, I just want to read something that you wrote because it stayed with me. You said, quote, "We are like ants preoccupied with our jobs of carrying crumbs in our minuscule lifetimes instead of having broader perspectives of big picture patterns and cycles, the important interrelated things driving them and where we are within the cycles and what's likely to transpire." And of course, I think later in the piece, you even said that you're even just beginning to put together the crumbs, the picture here, and you don't have all the answers, of course, and no one really does. But I guess kind of to round it out here, what do you say? I guess you were kind of outlining what our world might look like, but if you could narrow it down to one thing, what would be the biggest issue that we need to tackle first?
Well, of course, the biggest issue goes back to one's approach to life. It depends on what level you want me to answer the question. But the biggest issue is be radically open-minded. You have to make your own decisions, and you have to make them well by taking in well, not by being closed-minded, and having the character to do it, and then going back and understanding histories and how the patterns of histories, and then take in from the people around you, the smartest people you know, the information and triangulate with them well to make that decision. That is, I would say, the overarching at any time, the most important things anybody could do. As for now, I would say to realize that these changes take a global view, make comparisons of countries, put things in perspective. And then if I narrow down to investing, so I'm getting more specific in answering your question, it would be first to realize that cash is not a safe investment. It's a very risky investment, and know how to diversify well. And when I mean diversify well, I mean diversify globally, in countries, in markets, and in currencies. Mm-hmm.
How about, do you have a take on digital currencies? This is something a lot of young people talk about. Any view on that?
There, digital currencies, let me break them down into two types. There's the type in which it's like a Bitcoin type of currency that'll be an alternative currency in terms of its supply, demand, and an alternative storehold of wealth. And then there's digital currencies. That means there'll be other types of currencies, let's say the dollar or the euro or the Chinese renminbi, that is digitalized. Okay, I think we're going to see a lot more of that second type. But I think that there are three main problems of the first type, the Bitcoin type of that. Theoretically, it's good, but the three basic things are a currency has to be an effective medium of exchange, storehold of wealth, and the governments want to control it. So I today can't take my Bitcoin yet and go buy things easily with it. And as a storehold of wealth, it's so volatile that its volatility based on speculation is so much greater that it's not an effective storehold of wealth. and which is also one of the reasons it's a problem to be a transaction vehicle, because if a vendor says, I'm going to get paid in Bitcoin, and they don't know what that means in terms of their other liabilities, that's a problem. And then thirdly, governments won't, and if it becomes material, governments won't allow it. I mean, they'll outlaw it, and they'll use whatever teeth they have to enforce that. They would say, okay, you can't transact in Bitcoin, you can't have a Bitcoin. So then you have to sort of be almost like, is it a felony? And I'm going to have to be a felon in order to transact. They outlawed gold. What's wrong with gold? But gold was a storehold of wealth. And so if I was to say, what would I prefer, Bitcoin to gold? No, I wouldn't prefer Bitcoin to gold. Gold will be the vehicle. There's either that central banks and countries use as an alternative to the regular cash, because each central bank can print cash. But through time, when countries dealt with each other, they used gold because they didn't have to worry about being devalued by some country that's going to print the gold. And so it still is our third largest reserves, if you take central bank reserves. The largest is the dollar, the second largest is euros, and the third largest is gold. So, so if I'm dealing with classic currencies, I'm really sort of getting into the storehold of wealth domain. That also includes stocks in that storehold of wealth. But I don't think digital currencies will succeed in the way people hope they would for those reasons.
Really interesting insights. And of course, I would recommend folks read The Changing World Order by you, Ray. And if you have any book recommendations, feel free to pass those along as well. Thank you so much for your time.
Thank you, Julie.
Ray Dalio, of course, runs the largest hedge fund in the world by assets, based here in Connecticut. When you think about the overall landscape of markets right now, it's so interesting because Ray Dalio basically teased the fact that he may not be operating in the markets for much longer, especially because he's 70 years old and he's trying to think about his own succession plans. I have to say, even though he's a finance guy, he was actually probably the most popular person here in the TechCrunch auditoriums. He did a book signing. It was really hard to even get him to sit down for this interview. I want you to take a look at our conversation. I'm joined by Ray Dalio, the founder, co-CIO, and co-chairman of Bridgewater Associates. Thanks so much for joining us today.
It's a kick to be with you.
Yeah, so we're here at TechCrunch Disrupt, and you are now the face of an app, right? Principles, and it's been getting a lot of heat and traction over the last couple of months. What is the success story behind Principles, and why do you feel like it's been performing well?
To know how to fail well, and to realize it's the path to success, to know that knowing how to deal with one's not knowing is more important than anything one knows, to know how to have an idea meritocracy, and to know how to have fun and go after your dreams and make that happen. And so it's a kick to pass that along.
So it's really interesting. The app itself, you're giving people the opportunity to craft their own principles, right? In addition to following yours, it's almost like, okay, this can be your vision board as well. What would you say is the most creative sorts of principles that you've seen others contribute to the platform?
Well, we're just starting to collect the principles. So But there's the themes that you see over and over again, and they're true.
Yep.
So I wouldn't make the generalization. I can't imagine are open-minded and thinking about new and better ways of doing things. So Silicon Valley, I love it because they really resonate the idea of meritocracy. To know one's strengths and one's weaknesses, to work in a community where there's meaningful work and meaningful relationships. It resonates here. So that receptivity is really big here.
And you personally have really taken to social media platforms like Twitter, like LinkedIn, to really be an author, right? In addition to your book, and you're finding avenues to express yourself and engage with customers and people who are interested in your words. Would you say LinkedIn is the best portal?
I want to clarify what I'm doing. I was sort of hesitant. I'm going to go on social media, and I don't know. And I'm not doing it for most of those reasons. I'm doing it because I'm having quality exchanges with people. Every day we're exchanging thoughts on principles, and we're having the back and forth, and the people are really nice, and they're very appreciative, and I love communicating with them. So, I like that. We're communicating in very honest ways. But most importantly, it's quality. Like, what are you facing? And to realize that whatever you're facing, there's a principle for it, right? To not view each of these individual things as individual things, but part of that principle. That back and forth exchange has been really well. I'm loving the communication.
I want to briefly touch upon your latest LinkedIn post where you specifically are addressing the administration potentially curbing some of the investments into China and the capital flows there. Would you say that is the optimal scenario? Is that the way that the U.S. government should be going about relations with China?
No, I wouldn't say that. There are four types of wars, right? There's a trade war, there's a capital and currency war, there's a technology war, and then there's a geopolitical war. And I'm seriously concerned about the nature of those wars. So, it has to be done. This exchange of how you accomplish things we shouldn't even be using the term war. We're using it too easily. We should be using the term negotiation, I think. So, the question is, how much will this be a fight in which there's mutually hurting each other? Is this a win-win or a lose-lose? However we can get to a win-win, that's what I would like to see the most of. It's the art of thoughtful disagreement. And how do you create win-wins that I would like to see the most of? So I would say more concerned about conflict than the way that we're having it.
And when you think about that win-win scenario, what does that look like, for the U.S. and China? Well, do you see that sort of compromise happening?
I don't think it's just a U.S.-China. I think it's an American-American thing. In other words, I think when we're dealing with conflict, we're now saying, can we go above it so that we don't make it a lose-lose, so that we know how to get what we each want through exchanges. Like, you tell me what you want and let me see if I can help you get it, and let's do the same so that we build on win-wins. I think we're having the same challenges domestically. There's a wealth gap, and there's an opportunity gap, and then there's a conflict between increasingly extremes and a fight that can become a really dangerous fight and produce a lose-lose. So I think the issue is to go above, if we can go above it, and we say, how do we get the best collective benefit, and work on that. That's now lots of ways we can do that, but that is, I think, the most important thing. Because if you look about what we can have, there is enough. Okay, there is enough of everything, and there's an innovativeness, and there's a capability. But so often, there's been these lose-loses that can then be very damaging. So I'm concerned about that. So like the wealth gap, like the opportunity gap, the idea of coming together and working it together and understanding the art of thoughtful disagreement. Principles, go back to principles. What are the principles that bind us together? Are we clear on those? What are the principles that separate us? So I think we have to think about how we do this in a together way before we really damage ourselves, because it can get so extreme that it can be damaging.
And on that point, when you think about unity within America, of course, there seems to be a lot of divide within the U.S. political system. When you think about the impeachment inquiry that Nancy Pelosi did start on President Trump, do you feel like that will be a headwind for the markets as you think about the next couple of months?
I read history, and I find the same things happen over and over again. And what I see is that there is a political system that normally has an ability to debate things and get past that. And I'm worrying that this is a war in which the damaging and the hurt of that war can be so great that it undermines the effectiveness of the system. History has shown that. If you look at the late 30s, for example, the polarity between the haves and the have-nots, the wealth gap was analogous, the opportunity gap was analogous, and the ability to get past that. So I'm more concerned about that. I think there are three big forces that are at work. That's the domestic, economic gap and political gap, which is becoming extreme. And I worry about a downturn in which, number two, monetary policy won't be as effective in the next downturn. If we're at each other's throats now, and then you have a downturn, and it's going to be worse.
Yep.
And then we have the conflict in terms of the rising, China as a rising country with the United States as an established country. And so to work oneself through that in the right ways with wisdom, to understand the art of thoughtful disagreement and get at the right aggregate rather than an everyone lose situation. That's what, so that's what worries me.
Hopefully we can achieve that soon. Thank you so much,
Hopefully we
Ray,
can
for
achieve
joining
it soon.
us.
10 years ago, Wall Street and Main Street were devastated by the 2008 financial crisis. Now, while many struggled, a few investors saw the crisis coming and were able to successfully navigate it. Ray Dalio, the founder of Bridgewater Associates, the world's largest and most successful hedge fund, was one of them. Now, inevitably, there will be another crisis, and Ray Dalio is now sharing the same principles that helped him back in 2008 in a new, and get this, a free book called A Template for Understanding Big Debt Crises. Ray joins us now. Ray, welcome. Thank you so much for being here.
Thank you for having me.
All right, so Ray, our audience will obviously want to know, how were you able to foresee the last financial crisis? What signs were you seeing that everyone else was missing?
Well, the way I look at it is it's like a disease. It's like a process that happens over and over again. And so I laid them out in 6 steps and then described them in 60 pages, really, the sequence of how to look at each of those phases. So that basically, there's I don't know if you want to get into the 6 phases.
Oh, we'll get into it in just a bit.
Okay. But there's a process. Everything that happens has a cause. And by understanding that process and cause, you know the red flags. And with those red flags, you know how to calculate whether people can pay their debts back and how the dynamic's going to work. And that's why I want to pass it along, because in those 60 pages, people then can learn that. And I'm at a phase in my life where I want to pass along those things that could help other people and ideally help to prevent the next debt crisis, or at least help people navigate it.
Okay, so we're going to get into those 6 stages in just a bit, but I do want to go back to that time around just before the crisis when you were at Bridgewater, and you have this process in place. But what was it? What was that red flag for you? What was really flashing for you at that moment where you realized this was coming?
Well, we had calculated that a number of the entities would not be able to pay back their debt. When there's a certain rate of debt growth that is unsustainable and that there's going to be a problem paying it back, when you do the calculations, you could see that you have a problem. When you start to have a debt problem and you're close to 0 interest rates, that means that the central bank, the Federal Reserve's ability to deal with that won't work. You'll hit 0. And then you enter a new world. Okay, the last time that happened was 1928 to 1929, 30, 31. That's what happened. What happened in 2007 and 9 was the exact same thing. A debt crisis, too much debt, and you hit 0 interest rates and out of luck. And then what happens, there's a classic way of dealing with that, is that the central bank has got to print money and go buy financial assets. And so that's what all the entities did. And so by being able to watch it day by day as to how they went about doing that, allowed us to navigate the crisis so that we could see the rates of deterioration and then the actions taken to end that in much the same way as the Federal Reserve ended it in 1932, 1933, for the same reasons. Now that printing of money and the buying of financial assets causes financial assets to go up in price, right, puts money into the economy, and produces the type of reaction that we've now seen in terms of that economy and those markets. Then we're at the stage of the cycle where we are now. And what happens, classically, is that those financial purchases help those who have financial assets more than they help those who don't. And it causes a greater wealth gap. And very classically, that causes populism. Right. Because there's a gap between the wealth, on the wealth, and then you move into a situation that's very similar. So being able to see mechanically how that dynamic worked allowed us to navigate it well.
And history does repeat itself. These are patterns that repeat over and over. Now, you did highlight in your book 6 stages of the debt cycle. But if you could zone in on those 6 stages, which stage are we in right now? We have a graphic up right now.
Yeah, so I'll touch on it. The early part of the debt cycle is the great part of the debt cycle because the borrowing of money is being put into assets that are going to be able to pay back that debt and grow, and asset prices go up. Then you enter the bubble stage when everybody is extrapolating that because it happened in the past. Because those assets went up, they're going to continue to go up, and they're going to continue to rise, and it pays to borrow money to do it, but they're not able to actually pay off their cash flow. The top of the cycle usually happens when when the bubble exists and also the Federal Reserve or the central bank begins to tighten money to slow that bubble at the high part of the cycle. So as we take a look at that, we are approaching more of the top of that cycle. I don't think we're there yet. I think we're in the 7th inning. When you have that tightening, and then you have the turn down, and what I'll call the depression phase. That depression phase happens because you hit 0 interest rates and because they're less effective in monetary policy. That's why 2008 was like it was in much the way 1930 was. And so that's the depression phase. You can then, the central bank has tools. And so in my opinion, on this long-term debt cycle, we are relatively late in a longer-term debt cycle. We're relatively late in a business cycle. That doesn't mean imminent. I mean, I think there's 2 or 3 more years probably in this. I'm not sure for sure. But we are then going to have a downturn at some point. Downturns always come. Recessions always come. And what we have is a situation in which the capacities of the central banks to reverse it are more limited because interest rates are close to 0 or is at 0 in Europe and Japan. And also, the effectiveness of monetary policy is largely, quantitative easing is largely behind us because they have put that money in and those asset prices have risen. We also have another issue, which is the wealth gap and the populist issue, because, which is, I think, worse than it was back then. So imagine today, we have the best economy that you probably we're going to get. The unemployment rate is low. The stock market is where it is. Asset prices are good. These are times that are good, but we have this polarity. So if I'm looking at 2 or 3 years forward, that's the period that produces greater concern. So I think we're relatively late along in that cycle.
Right. Well, what you're saying is really concerning, especially given what we just experienced with the financial crisis. It seems so fresh in our minds. So this sounds like the downturn would be even more severe than that scenario. Looking back in history, what would you say it's most analogous to?
I think everything is most analogous to the 1935 to 1940 period because of the number of things I mentioned. The quantitative easing, buying asset prices, the populism, where we are in the cycle. 1937 is when the Fed started to tighten monetary policy. We came in the later part of the cycle. Populism in a number of countries, that kind of an environment. Tensions internally, left and the right, you know, the political left, the political right, the rich and the poor, tensions between countries. I would say it's the most analogous period in the 35 to 40 period.
Wow. And,
it's worth studying that period.
And if you do look back at that period, that was leading up to World War II. Is that where we're headed? Is it going to be something playing out like that?
You know, I certainly hope not. But I think when you study history, you realize that economic conflicts cause political conflicts. Mm-hmm. So let's say Japan. There are parallels between Japan and China in that we had the tariffs and we had sanctions through a period of about 10 years. 1931, we also had Japan expanding in the region, in northern China and Manchuria and so on. Mm-hmm. And we had economic sanctions back and forth, and we had tensions. I think it's very important for the parties involved, whether they're having conflicts internationally or domestically, to be able to approach those things with a calmness and a mutual understanding. The whole concept of war, I mean, just even the notion of trade war and fighting, I think it should be a trade negotiation and the fighting. I think it will depend a lot on how we behave with each other over the next 5 or 10 years.
Well, I mean, you just mentioned trade. How are you thinking about the trade tensions between the U.S. and China and then elsewhere?
I think there are trade tensions, and then there are ways of being that are different. A Chinese leader described to me, he said, the essence between the difference between an American perspective and a Chinese perspective is what unit you value. The United States values the individual. And as the individual, and there's individual rights, individual freedoms, all of that. And then, and when you deal with property rights, for example, if you have the property right and you want to build a road, the individual can block that because of his property rights. He says in China, we think that the family is the most important. He said the definition of the way they write country is through 2 Chinese characters. It says state, family. And if you would imagine how we as leaders run China, we would run it the way you would run a family. So you think about what's for the good of the family, and it is more top-down. So they have a system that is more top-down that we would say we would say maybe is not consistent with what our bottom-up approach would be. So they would say, I think, for example, the notion of China Inc. In other words, they want to take care of their companies, and they think, okay, how do I take the best care of our companies, and how do I help them compete in the world markets, and so on. That approach is in conflict in many ways with this bottom-up approach. I think the trade issues themselves are not a big issue, that the Chinese and everybody can get past that issue. I don't think the way of being issue is going to be an easy one to get around, because that approach to life is very Confucian, it's very family-oriented in that way, and so I think that there's a way of being issue. We're coming, today I just read that President Trump is considering economic sanctions for certain people related to the their handling of the Muslim crisis or the Muslim situation in China. I don't know much about the Muslim situation in China, but I do know that the notion of economic sanctions in what they would consider to be their domestic issues is something that's a hot button for them. In much the same way, perhaps, if they were to operate in our issues, or maybe how we feel about what's going on with the Russian situation. So I think that those issues, how you use economic sanctions and what replies they cause, are important issues in terms of approaching this next 5 or 10 years.
And how about China's debt issues? They have some debt challenges that they're facing. How could something like the trade tensions impact that?
The main things to understand about a country's debt is, first, is the debt denominated primarily in their own currency or not? If you have a debt that's denominated in your own currency, the capacity of being able to deal with it is great. You can spread it out. You know, if you ordinarily would have a 30% markdown, you could take that over 30 years and have 1% a year, or you can monetize some of it the way the central banks bought it and took it on their balance sheets. There's a lot of maneuverability. So the Chinese have a lot of maneuverability because it's in their own currency, most of the debt. In addition, the question is, do you have the ability to make the decisions? Sometimes politics enters into those decisions. In the 2008 financial crisis, if you study it, an example, the question is, would the law allow you to save Lehman Brothers, or those laws and rules? They don't have those types of issues, and they have an expertise. I mean, I know them, the decision makers, well, and I know that they're very capable, and they have ways of understanding of dealing with that. I've been through 4 major debt crises in the United States, okay? We couldn't pay our debts in 1971. We had a debt crisis. We had a savings and loan crisis. We had in 1982 a world debt crisis. We had the 2008 financial crisis. These things can be managed if it's in your own currency and you know how to handle them well. I think that's the situation in China.
Well, I do want to talk about my generation, the millennials. We were really coming of age during the crisis. So how would you advise us to prepare, and I guess, what would you tell our generation? We feel scarred from the crisis.
Yeah. First of all, I think one of the problems is that the experience that you had as the last experience is the one that's going to stick in your mind and probably will not be the one that's going to get you. So that the next experience will be very, very different. I know my parents went through the Great Depression, and then they missed out on the boom because they were always thinking about that. And so I think that what they need to do is see all of those crises. That's why you can see inflationary ones and see all of those. And once you get that perspective, I would say three things to your generation. Okay, three recommendations. The first recommendation is to think about your savings and how much money do you have for savings. And the best way to think about that is to think, how much money do I spend each month and how much money do I have saved so that I can, how many months am I going to be okay without that? And to value savings, right? And calculate it, because savings in that is freedom and security, and think about what that is. So that's the first. How much do I have for that? The second thing is, how do I save well? What should I put my saving in? And when thinking about what you should put your saving in, realize that the least risk investment that you think from volatility is the least risk investment, which is cash, is the worst investment over a period of time. And you could judge that by judging the rate of inflation in relationship to the after-tax income you're going to earn. So if you have an inflation rate that's 2 or 3% and you're earning 1% and you have to pay taxes on that 1% or the 1 or 2% that you're going to get, you're going to get taxed essentially at 2% a year, and that's going to be a problem. So you have to move into assets that are other assets that are going to do better over a period of time. And when you do that, the most important thing I can convey to you is to diversify well, because I can guarantee you that one of those assets, and you won't be able to pick the right one, will be disastrous in your lifetime, that you will lose half of that savings if you're in the wrong one, and you won't know what the right one is. And so pick different countries, pick different asset classes, and I could probably take too long explaining how you might do that. But so that would be the second thing to learn. First thing is think about how to save. Be cautious about debt. When you're thinking about debt, think about, is that debt going to help my savings, or is it going to produce an income? Sometimes debt, like buying a house or buying an apartment or buying an asset, it produces forced savings. Forced savings is a good thing. Or if you're taking on debt and you're thinking, am I going to have that debt in an asset? That asset better produce more income than the cost of your debt. If you're using debt for consumption, that's not a good thing to do. Okay, you're giving up that safety. So number one is think about how much you save and think about whether that should be how you borrow. Number two, make sure that you think about the diversification of that, not in cash. And number three, do the opposite of what your instincts are. If you're going to play the game, it has to be the opposite of what your instincts and the crowd says, because the market reflects the crowd. So you want to buy when no one wants to buy, and you want to sell when no one wants to sell, right? So, and that's emotionally difficult. And probably you're not going to play that game well, because it takes a lot of resources to play the game. We spend hundreds of millions of dollars each year to try to play that game well, and it's a tough game to play well. So I would caution you about the market timing game, but I would say that if you're going to do it in the ways that are uncomfortable, because they're opposite your instincts.
That's really good advice, Ray. One more thing that really resonated with me in the book was, if in the next downturn, some of the implications could be the impact on pension obligations, health care. Is my generation going to be on the hook for that?
Yeah. So we pay a lot of attention to debt, and we should, but pension obligations and health care obligations are just like debt. There are obligations that require cash to fund those things. And when you think about that, we don't have enough money to fund those things. And so there'll be a squeeze. And I think that's also part of this political conflict, because when you say to somebody that you're not going to be able to fully fund their pension, or how are you going to fund it, what are you going to take it away from in order to fund it? Or if you think about the healthcare issues and so on with the demographics, and those require taking things away from people that have been promised to people, or do you print the money? These are issues that will be important for your generation.
And not only are you an incredible money manager, but you're also a really big philanthropist. And when you're talking about the next downturn, you're also bringing up some big social issues, the wealth gap. How do you think about that? How do we address this issue? Because it sounds like it's going to be a very big problem.
Yeah, I think capitalism has got to work for all the people, and democracy's got to work for everybody. And we're in a situation right now, because of a lot of things, that it's not working for a large portion of the bottom 60%. I separated the averages to the bottom 60% and the top 40%. I could have done it the 80% or even 95%. And it's not working for a large percentage of the population. We don't have adequate education. We don't create bottoms. In many cases, my wife works in Connecticut to try to help what are called disengaged and disconnected youth. Let's give you a picture. Connecticut, which is the richest state in the country, or equal to the richest state in the country, has 22% of its high school students are disengaged or disconnected. Disengaged means they attend high school, but they don't really study, they just sort of get through. And disconnected means they don't even know where they are. 22%. Now those students, those people are going to be on the street. That's a problem. There are school districts in which they have to share books, or in some cases even have to share pencils. They literally will break a pencil in half and sharpen it from both ends, or pass it around and so on. And that issue about opportunity in terms of education or even income opportunity. There's a population that in that bottom 60% where opiate use is rising and suicides are rising. I think there has to be considered a national emergency in which we create metrics. What are those conditions? And that there should be a dealing with that. I think that these things can be dealt with much, much better, but it has to be treated in a way that that's dealt with. And that has, by making them productive. I don't mean by giving money or by giving welfare, but by doing certain things, probably in private-public partnerships, in which the private sector, that could be business sector, together with the government sector, can do the checks and balances to make those things productive. I see many of these cases. I fund, for example, microfinance. Grameen America is one, but a number of those. And the capacity to lend somebody $1,000 and get paid back, not 99%, 98% payback rates. And that $1,000 can create the purchase of a rug cleaning piece of equipment, and that person's in business to be able to be productive. Those kinds of things need to be thought about, because if we don't have capitalism working for the majority of people, it's going to be threatened. And the same thing is democracy. The democracy is based on the notion of compromise, to be able to bring people together and so on. I think if we have too much fragmentation, I think that these are the biggest risks. I think debt crises can be managed, but when you get into bad situations, as a basic principle, if you have rich and poor living together, and they have to decide how they're going to spend a budget, how they divide a pie, and you have an economic downturn, you're probably going to have a conflict. And I think that has to be dealt with.